The IRS doesn't care if you work 30 or 40 years. They still want their fair share. And that's something a lot of times we don't fully appreciate when we're saving for retirement. Because when you contribute to a traditional IRA or a pre-tax 401k, 403b, thrift savings plan, or any other employer-sponsored plan, you're usually getting a tax deduction today. It's one of the biggest advantages of those type of accounts. You get the tax deduction today, and your money grows tax deferred over the years that follow. But there's an important trade-off that sometimes gets overlooked. You're not avoiding taxes, you're simply delaying them, because every dollar you contribute and every dollar of growth is generally taxable as ordinary income whenever it's eventually withdrawn. And one of the biggest assumptions people make is the idea that they'll be in a lower tax bracket when they retire. And yeah, of course, sometimes that is true. There's also plenty of cases where taxable income can stay pretty high. And if you think about all the income that may be coming in retirement, maybe pension income, sometimes multiple pensions, you got Social Security, maybe there's income from part-time work or consulting, maybe there's interest income or dividends or capital gains from investments you have outside of retirement accounts. Maybe there's some rental income or other business income, the list goes on. And so then you add on to that traditional IRA or pre-tax retirement plan distributions, which even if you don't want or need to take them, at a certain point, you're required to. And before you know it, your taxable income looks very different than you anticipated. That's why one of the most valuable things you can do before retirement is tax planning. So looking at the years ahead to try to determine when it makes the most sense to recognize income. So maybe that's taking IRA withdrawals before you have to and delaying Social Security. Maybe it's doing Roth conversions during the years where your taxable income is temporarily lower. Like, say for instance, if you're between jobs. Maybe it's coordinating withdrawals from taxable, tax deferred, and Roth accounts to keep yourself in a lower tax bracket. Because those types of decisions can potentially save tens or hundreds of thousands of dollars over the course of retirement. So here's the way you got to think about this. If you have $1 million in a traditional IRA, you don't actually have $1 million to spend. You have $1 million account, but part of that account already belongs to the IRS. So the question isn't whether you'll pay taxes. The question is when you'll pay them and how much you'll pay. And good retirement planning is simply about making sure that you keep as much of your hard-earned money as the law allows.